Welcome everyone, thank you for tuning in. This is the MSV podcast. Here we talk about crypto. My name is Sabi, I am your host today. Let's start. Hello everyone, thank you for tuning in to another episode of the MSV podcast. Today we will learn about lending protocols and maybe a bit about regulations. Please welcome my guest today, JD from Benqi. Hi JD, thank you for joining me. How are you?
Thank you very much for having me.
Yeah, my pleasure. Let's start with some introductions. Could you give us a brief background about yourself and about the project?
Yeah, I'll try to spare you the long explanation of everything, but long story short, I worked in TradFi for a number of years and have done a number of startups since then, and really got excited about, crypto and smart contract technology in 2015 when Ethereum coming on the scene, and I had read the white paper and got excited about kind of the potential of what smart contracts could do. And I think at the time, the paradigm, what I thought was going to be possible is orders of magnitude less than what even currently is possible, which is exciting. But at the time, got excited, obviously got involved, got invested in a bunch of projects, and supported fundraising and advised a bunch of different projects through 2016, 2017, 2018, and then worked closely with a couple in 2019, and in 2020 started working on how we could build meaningful applications for the space and how we could really support the growth of DeFi in general and blockchain in general. And so we started Rome Blockchain Labs, which we have 30 plus full-time engineers working on a few different projects. One of the projects was Benqi. And, we started Benqi very early on when nobody really knew about Avalanche. We were early investors in Avalanche, all the way back to the Avalanche white paper. And it's really looking at what the ecosystem offered. And obviously we're starting to see, I think, the fruits of Avalanche labor. But we were very early. We worked very closely with Avalanche Labs. And to get the DeFi ecosystem kind of sparked and get a meaningful amount of participation. Lending protocols, of course, are a primitive in the space, and here we are.
Okay, sounds like you have a lot of experience. I mean, I think 2015, 14, maybe that was the big start of DeFi, of everything which is not Bitcoin, right? I mean, that is when Ethereum was founded, and from there everything starts. I just have a couple of interviews with other projects, other people, and I think that is where the most experience started for people who built many kind of projects on blockchain.
Yeah, I think it was kind of that light bulb moment when we went, oh, blockchain isn't just about tokens, Bitcoin. There's other ways that we can use the technology, and I've got a whole other set of stories of kind of what I did between 2015 and 2018, 19. It's probably not relevant to go into, but being able to see in different contexts what blockchain really was capable of, I think was what really changed my trajectory, I think, in the space, from just investing and participating to building and building teams and building projects. And we're really only scratching the surface, and we can talk a little bit about that later. But I think it's still an emerging technology. We're still, I believe, at the fairly early end of the adoption curve. We've got the innovators and then the early adopters, I would argue, is kind of where we're at now. We're starting to move into the kind of middle of the bell curve. But there's a lot of technological advancement that still is yet to happen, and a lot of participation globally that it still is yet to happen. And those two things generally go hand in hand. I think we're just at the beginning stages of building out the technology to a global scale and to see a greater amount of participation. It's exciting, obviously.
Yeah.
Exciting to be here. Lots of cool stuff going on. So.
Yeah, I mean, I think you just touched one of the biggest topics, which is talked, with the DeFi boom, with the NFTs and everything, and now everyone is questioning whether we are in the early adoption phase or pioneering. Maybe it was just before Ethereum, or just after Ethereum, and where is the curve? Where is the top of the curve? Because when we reach that, then maybe some people will start to look for something else, or something a new innovation, let's say. But I do think that we are a bit far away from that. Maybe we will need to see a couple of years, maybe 10, 15, until we reach the big adoptions, and that blockchain is widely used on in companies and institutions, and then we can say, okay, now we need something newer, some new wild west of something.
Well, we talk about parallels. I talk about this a lot, and I still think we're kind of in the the late 90s to compare another kind of emerging technology. It's kind of similar to the late 90s of the internet, Web 1 and eventually Web 2, where we're seeing a lot of potential use cases, a lot of companies and builders are starting to emerge. We're kind of seeing a certain amount of traction and adoption globally. But blockchain will be the technology, in my opinion, beneath almost everything we use in our day-to-day lives eventually. Very similar to how the internet has become. We couldn't function if the internet went down in America. I don't know, nothing operates. I'm Canadian, and it's interesting because we had an internet service provider in Canada go down a month ago for like a full day or 2 days. And all the banking infrastructure shut down, and like a whole bunch of stuff shut down, and you don't realize how deeply connected you are to the internet. And I suspect, actually, I'm very confident that we'll see the same thing with blockchain, in the coming decade. We're all kind of figuring out the technologies we're building. We're trying to figure out the regulatory. We're going to talk about this, I'm sure, but we're trying to figure out kind of what the regulatory environment's going to look like. And once that kind of happens, as takes time in all emerging technologies, then we're going to see a lot of blockchain underneath. And we probably won't even notice. You don't know how many things operate on the internet. It's going to be very similar.
Yeah. Just like in brackets here, some people who are not in crypto, the first question I get is, okay, what happens if the whole internet just ceases to exist, And I'm like, you know what? If the internet just ceases to exist, the smallest problem you will have is your crypto. We will have much bigger problems, and we won't even think about our crypto investments if the internet stops. So yeah, very good point on that. And yeah, it's very interesting to see how it develops. And I also think that, yes, blockchain is in the early phase, but even the internet is still in development, let's say. It is still evolving day by day. So
absolutely,
it's not something that, okay, we need to leave that behind and just jump to something else. But let's talk about Benqi first, because I think we already derailed a bit from the topic. So could you tell us a bit about the project, about Benqi, and maybe how lending protocols work, and opportunities, risks, some general knowledge you could share with us?
Sure. So Benqi, by definition, is an algorithmic liquidity platform. Fancy way of saying it's a lending protocol. We lend and borrow. We facilitate lending and borrowing of assets on the blockchain. Benqi was intentionally built the way it is to be, modeled very similar to Compound. Obviously, we've made some iterations on Compound, but generally speaking, lending protocols become kind of one of the early primitives or early building blocks from which DeFi can then build on top of. The easiest way to understand a lending protocol is it's very similar to how banks used to operate once upon a time. So you have some assets, you want to free up the equity in whatever those assets are, and borrow against it without having to sell the asset. You might want to maintain your exposure, or there's tax consequences of liquidating your asset, so on and so forth. So you can deposit that asset as a collateral into a lending protocol. In our case, we're an over-collateralized lender, so you have to collateralize more than you could borrow, as identified by collateral factors on the protocol. But to make an easy example, you have $100 of asset A, you deposit in there, you might be able to borrow $70 against that 100 in a different asset. There are use cases where you might borrow the same asset, but we won't get into that. Generally speaking, you have some sort of asset that you want to borrow against it to do something else. It's kind of a way to use leverage of sorts. It's not leverage like perps or like futures or a lot of these leverage protocols that we see. It's a little bit different, but it's very similar to borrowing against your house, as an example. Your house is collateral, and you can borrow 80, 70, 90%, depending on different factors. And that's what makes the world go round, I suppose. So we're
Yes.
in the very early stages, generally speaking, as an ecosystem, not just Avalanche, but crypto in general, of understanding and building smart contract infrastructure to facilitate lend borrow. And it's an interesting paradigm because you're doing it in a trustless way. You're doing it in a permissionless way. At least Benqi currently is doing it in trustless and permissionless way. So you don't need to apply for these loans. You don't need to, go through any sort of underwriting process or anything like that.
Like review.
Yeah, you deposit your assets as long as your assets are there. As long as they're on the blockchain, they become the collateral. And if you ever get upside down in your loans, which you have to be careful for, if the value of one asset fluctuates more than expected relative to the other, then you could run into problems where you're bumping up against your collateral, your collateral factor, and that becomes an issue. And so, anyways, it's a fairly simple mechanic.
Yeah, so these are the risks. We all need to acknowledge that we are in crypto. This is in crypto, so there is a volatility, there's a fluctuation that needs to be taken in consideration. Let's say when you are, getting a loan, and just if anybody didn't understand, you have one Bitcoin, you want to trade with some, USDC maybe, but you don't want to sell your Bitcoin, so you can just put your Bitcoin as a collateral. You get the USDC. You trade with it, do whatever you want, and if you are good at trading, obviously, which is very risky, I need to highlight it here, then obviously you can make a profit without selling any Bitcoin. This type of loans, let's say, or lending protocol is very widely used in the real estate, for example. You have a house, you take a loan on it, and you buy another house, and you rent that out. So something like this. Am I understanding this correctly?
Yeah, it's a very similar mechanic. I think where people get slightly caught up in crypto is objectively, it's pretty rare that you're going to mortgage your house and take that money and go to the casino. And so, that would be unadvisable, of course. And something similar is in blockchain, but that's what we're seeing a lot of. We're seeing a lot of, people holding their kind of blue chips, which are generally the only tokens that lending protocols accept for a whole host of reasons, which we can get into if you desire. But they're borrowing against their blue chips and using the proceeds or the borrowed assets to then go, invest in a little bit more degen type activities. And that's all fine and dandy when the markets are going up. When we're in a bull market, everybody's making money. You want to leverage, I suppose, keep your Bitcoin, Ethereum, Link, AVAX, other assets. And then you want to take the equity in those and invest in coins that are going crazy. But the same excitement that exists, the flip side of that is when the markets come down, you can run into a lot of problems. We've seen a lot of liquidations happen. There's an interesting case study right now that's going on with NFT lending. And how that works, and how the NFT markets coming down have really caused a lot of problems for people that lent the assets with which they're providing leverage for NFTs and what that's done. So, anyways, long story short, there's a lot of risk. There's a lot of risk involved, not necessarily the way that the users normally look at it, but you have to be really careful. Volatile assets, they're marked. The value is assessed real time. So it's not like a house where that's the difference, where sometimes your house might go below in value what the collateral factor should have been, but that doesn't trigger an immediate liquidation of your house. In this particular case, it's different. So a lot of people are finding themselves surprised when they get liquidated if they're not managing positions properly.
Yeah, but just to give maybe a positive example as well, because we are talking about liquidations, I would imagine that maybe somebody who has Bitcoin from 2013, for example, and they want to build some to have a project, but they don't want to sell their Bitcoin, they could easily just put their Bitcoin as collateral and get some funding, let's say, for their project to build. So it doesn't have to be always for trading or anything else.
Absolutely.
Are these loans smaller or bigger value, or you have all of them?
Uh, Everywhere in between. I mean, so there's other cases, right? Not everybody that deposits assets into banking intends on borrowing against them. For the market to be efficient, there has to be people that are depositing assets because the interest rates for deposits actually make that worthwhile. And so another use case is if you hold Bitcoin and you don't plan on selling it anytime soon, you can bridge it to Avalanche using the core wallet, which is a different structure than using wrapped Bitcoin. It's unique to Avalanche and very exciting. But anyways, you can deposit your Bitcoin into Benqi and just earn yield that otherwise you wouldn't be able to earn, even if you don't intend on borrowing against it. That's what creates the liquidity in the pools for people to borrow and lend. But there's also a ton of other use cases. Example, if you've held Bitcoin for a very long time, you may not want to dispose of the Bitcoin just from a tax perspective. You don't want to create the taxable event of disposing of your Bitcoin. So you can borrow against it. I know a lot of people that were buying houses or buying businesses or starting protocols that are just borrowing against their assets because they don't want to create the tax event of selling the asset.
Yeah.
And if you manage your collateral properly, if you're not trying to degen, so to speak, it can be a wildly effective strategy. And if the interest rates for borrowing are, being managed efficiently, then it's not an incredibly high rate, and you manage it yourself, and you don't have to qualify, so to speak. And very few lending institutions take crypto as a balance sheet item. If you're going to get a mortgage on your house, it's fairly difficult to use crypto as collateral. If you're trying to get a business loan or different things, crypto as collateral doesn't normally work in the traditional world. So this is an opportunity to do so, which is exciting.
I was just thinking that, I don't know, are there separate regulations for the lending protocols? Let's just touch on the regulations a bit, because I want to go into that topic as well. I was thinking today that I think the worst which I can see right now is that crypto is so diverse. There are a lot of industries, let's say, in the industry. And what we can see from the government, from officials, they are trying to cover everything with maybe one bill, one regulation. We could see the salad bill, for example. They just included crypto in one section. And I think that it might be the time when maybe they pay a bit more attention, and they diversify also the regulations, because you can't just put the same regulation on mining and on lending. And I don't know if you could see something like this developing, or how it is different from 3 years ago. Could you give us some insider info on that?
Yeah, I don't know if I have insider info. It's something that we pay obviously very close attention to, both from forward looking. What are the opportunities? What are the things that are likely to come in the future, and how can we make sure that we're prepared? And then, of course, what is the environment that we're operating within right now, and how does that affect our protocol and users? And I mean, the regulatory environment is one that, in my opinion, is probably one of the most critical pieces of the current situation, I guess, is what's next. There's a lot of buzz now. There's been a lot of incidents of fairly public nature in the last little while. Exploits to a certain extent, you can't necessarily regulate your way out of, but in a lot of cases, what has led to the exploit is arguably negligence. I'm not speaking to any specific cases. Please, I just want to make that clear. That's a caveat here.
Yeah. I mean, we don't. Just in general.
Yeah, there's a lack of accountability, I think, due to the lack of regulation, that probably contributes a little bit more to these exploits than we would like to see long term. I mean, I think that's causing regulators and causing people to take a closer look at this. You look at Terra Luna as an example. Again, I don't have a formed opinion on what happened with Terra Luna, but the first and second and maybe even third order impacts of that situation were catastrophic to many people. And that highlights, in my opinion, there needs to be some sort of framework. Self-policing, obviously, throughout human history does not generally work because you have misaligned incentives. And so I personally am a fairly big proponent of eventual regulation. I may be somewhat alone or somewhat of an anomaly, not alone, but I might not be in the majority in that opinion. But I think the next major inflection point in the space and in scalability for the space will come with some flavor of regulation. And so you asked some questions before about kind of how has things changed in the last 3 years. I mean, 3 years ago, regulation was a twinkle in someone's eye, both regulators and participants. And I think now that we have more global awareness of crypto, DeFi has become a meaningful space with a meaningful amount of participants. And then we've had some pain. We've had pain in the last little while that I think magnifies the need for this and the desire for regulation from a stakeholder perspective. And so we're getting a little bit more clarity. I don't think there's going to be one bill that, covers the regulatory questions. It's definitely going to be an incremental process. From a lending protocol perspective, currently, because we're permissionless and trustless, currently there's no regulatory structure that looks over us, so to speak, with the exception of course, whether our token is considered a security, which it's not. And we've gone to great lengths and continue to go to great lengths to make sure that we understand and can avoid any issues. Loomis Gillibrand is a proposed bill that we've all been looking at kind of closely, that fairly loosely defines where and how things, whose purview they're under, CFTC, SEC, whether you're under banking regulations and so on. I think probably the most likely areas of focus at the moment is going to be stablecoins, who regulates them and how, and then of course securities regulation. When and how are you considered a security? If you want to be considered a security, how do you go about registering? And then everything else, in theory, should be under CFTC as a commodity.
Okay, thanks. Well, that was very informative, to be honest. I mean, we don't always think this whole thing through, but you guys, you are working with it, and you really look in the future and expect some things, and that's why I always like to hear what you think will happen. Now, if we go back just a bit to the exploits, I mean, regulations, yes, we need them. They are always there. I mean, we can see it in the history. Regulation is created when there is an exploit. Somebody gets away with something, somebody gets hurt. Therefore, a regulation must be put in place. Do you think we can reduce the over-regulation, let's say, with some education? Because now, for example, I think let's talk about the rug pulls, for example, the do your own research. As more and more information is out there, on Twitter, on YouTube, more and more educators are in the space who are there for years. I mean, I can't say decades, but 2, 3, 5 years. Then people, even those who just get into the space, they can get a lot of information. And if somebody really wants, and if somebody really says that, okay, this is my hard-earned money, and I'm not gonna just buy any Ponzi, maybe I think some regulation can be, let's say, skipped, or they are unnecessary in the future if we get the education level to a certain point. What do you think about that?
Yeah. So again, there's kind of our ideal environment and I was in the space early, like a lot of people, and most of what drew us to the space originally was, breaking away from bureaucracy, creating greater efficiencies, breaking down governmental or geographic barriers, global access. A lot of those things are what brought us all here. But I think as things evolve and as we see how the space has evolved over time, we have to take a step back and say, okay, the ideal and then the reality are somewhat divergent at the moment. And how do we find a way to bring reality as close to the ideal as possible without crossing that barrier where, we end up in the ideal in terms of the outcome, but the collateral damage is catastrophic. And so these are big questions, my friend. I think you're asking big questions. Does education, I'm going to use an example, an example that probably we can all relate to. The legal systems in most Western countries for example, the laws, what's criminal, what's not, taking crypto out of the equation. It's like saying, as long as we teach people that they shouldn't murder and steal and speed and do all of these things, we can educate them into acting like good humans. And the vast majority of people, that's probably true. Most people, whether there's punishment or a law in place or not, they understand good moral behavior, generally speaking. What's moral? Who defines moral? Totally different conversation. But let's assume that the vast majority of society can, through education, learn how to make smart decisions and not do anything to harm others. Unfortunate reality is we need laws, we need law enforcement, because not everybody acts within that framework, right? There's criminals, of course, that even with laws still act outside of the framework. And then there's people that just unfortunately don't understand the laws, right? They don't have time or wherewithal or maybe intellectual capacity, who knows, to follow the laws as they currently exist. So yes, education is critically important. I don't think that with a focus completely on education that we can avoid regulation, because regulation and laws generally aren't for the bulk of people. They're generally for the outliers. They're generally for the unsuspecting retail participants that don't have access to education or time for education. There's a reason that in the investment world, in traditional finance, I can't be an educator unless I'm licensed to do so. And so even if you want to educate, there's got to be some structure of determining what is good education, right? Who is qualified to give that information? If you look at crypto Twitter as an example, there's a lot of influencers and people, some of them great, some of them absolutely unqualified to give any information to anybody. And so we also have to figure that out. Who's a qualified educator? How do you identify that as a user? Who should I listen to? Are they useful? Are they not? Are they informed? Are they not? So those are important pieces. I think we have a lot of work to do still to figure out kind of what is good education. How can that take the place of regulation? But I do agree that we should keep regulation to a minimal, but I think it's still going to cover the space broadly, to have any meaningful impact. The other thing with this whole, here's kind of the disclaimer, do your own research, there's risks involved. Yeah, I think that's a cloak, in my opinion. That's a cloak that a lot of people hide behind. A lot of projects, a lot of developers, a lot of influencers hide behind, well, I said do your own research. Cool. But that doesn't relieve us of the obligation to also be good stewards as protocol builders, as influencers, as people in the space. I don't think we can do dumb shit and just say, do your own research. We're testing this in production, so if you lose all your money, it's on you. I don't think that that's a morally acceptable way to approach the space. It's saying, it was buried in the fine print somewhere. You should have read the 400 pages of legal disclaimers that we had. Well, that's not really okay, because who's going to read that? Do they have the capacity to understand it? Do they have the context to understand fine print? I mean, you look at the Celsius situation where somewhere buried in fine print somewhere, it said that in the event of insolvency, you become the debtor, essentially. Like you become the person that maybe cannot ever get your assets back to save the company. And I'm paraphrasing, and I'm intentionally not getting deep into that. But the point is that yes, it existed. Yes, it was in terms and conditions somewhere. But do you think people were meaningfully informed of what those risks look like? I don't know. Do people at all have the foresight in an emerging market to understand, it's unconscious incompetence. You don't even know what you don't know. Are you positioned to make a decision? And I think that's on us in many ways as builders to have some responsibility there and some accountability there for protecting people, and not just saying, hey, we're doing dumb stuff or we're doing incredibly risky stuff, but do your own research. I don't think that's a way to absolve ourselves of responsibility.
Yes, I agree. And I do think that we will see some independent institutions maybe who do some reviews, maybe give certificates, and they will also advise. I mean, even, for example, let's just not talk about crypto for 1 second. I worked in the mechanical industry. I was designing stuff, products. There are also some rules that you cannot overload the fine print regarding security. Now if you are producing a knife, you obviously cannot say that look, it's a knife, you might cut yourself. You will put it there, it is there, it's a knife, it's in the name. Obviously people are taking that risk. But if you're doing something which has, let's say, hidden risks that cannot be covered in the fine print, buried somewhere, that hey, you might lose a leg or something, but it's on you because you didn't read the fine print. So I totally agree with you.
And using that same example, I think that's so. I mean, you can assume a normal person would assume knife, sharp object, probably can cut yourself. You probably have to say, hey, try not to cut yourself with this knife. Like, don't be an idiot. But if the knife all of a sudden explodes in your hand and blows off your hand, you can't say, well, you should have known that there was risks involved. Well, no, the average person wouldn't have expected a knife to explode in their hand. And so us as developers or us as product designers and builders have to make sure that that shouldn't be possible. And if it is possible, people do need to understand what those risks are. Now, there's some risks that we just don't know. Like we can't possibly foresee certain risks. We're going to beat up this story, but
it's okay.
The metal in the knife erodes under certain circumstances, and maybe we didn't see that happening. As soon as we do see that that's a possibility, it's our job as the knife manufacturer to make sure people know, and we have to be accountable for that. You can't possibly foresee everything, but I do believe right now we're all kind of passing the hot potato to someone else, and the people that are holding the hot potato in the end is retail. And for some reason, the space feels comfortable with that by saying, well, there's outsized risks, do your own research. It's a new technology. Yeah, fair enough. There's a certain amount of that people have to take, but we can't just make haphazard decisions and just throw the hot potato at retail. And that's currently, in my opinion, what's happening.
Yes, I agree. And I think this drives back to the previous topic we discussed, about you saying that we cannot have only education because that has like huge risks in collateral, and also the overregulation might dampen the space, let's say. So we need to find that balance where the collateral is never zero, let's say, the potential risk, but it needs to be minimized as much as possible to keep people safe. And with the example of knife, literally keep people safe, but with crypto, keep people's investments safe and make sure that nobody is wrecked because some information was not visible, let's say. Can we say that?
Well, yeah, and I mean, people are going to get wrecked, generally speaking, in crypto and TradFi and penny stock. Like, it doesn't matter what you're trading, you have the potential, if you make dumb decisions, to have results that you don't love. But I think it just has to be a level playing field to a certain extent, and there needs to be certain safeguards in place. And again, certain amount of accountability and responsibility should be placed on the people championing these protocols. If you're a builder in the space, there's an opportunity to make a good amount of money. But I think having that remuneration and those rewards for early builders comes with should come with a certain amount of responsibility. At least for best efforts and for doing everything you possibly can to protect your users. And I think there's don't get me wrong, I think there's a lot of platforms in the space that do take that seriously, whether there's regulation or not. But it's not the good platforms that leave a stain on the space. It's the outliers, which is why regulation is important, that have the potential to have catastrophic effects. Three Arrows is a prime example. You look at what Three Arrows sucks. It sucks for all their LPs, but the second order effects are also really crappy for the greater market as a whole. I mean, Three Arrows has issues, kind of on the back of what happened with Terra Luna, but the market impact and the amount of regular users that are getting completely hammered over the second order impact or influences of those fallouts.
Yeah, it's a chain reaction, a big one, and it happened. I think this is also part of the early adoption part when we need to figure out stuff.
Absolutely.
But I don't want to keep you all day. I think we could discuss about this 24 hours, and we still wouldn't finish the topic. So let's talk a bit about Benqi, about the project. Why did you choose Avalanche?
Sure. Yeah, we didn't talk about our liquid staking initiatives, which I'm sure we can come back to, because we're not just a liquidity market. We also do a lot around liquid staking. But we chose Avalanche for a host of reasons. I think, I mean, we were fans of Gun and Kevin before the white paper and had followed their work on distributed systems and cryptography and different things. And I think they're just incredible stewards of the space and stewards of the technology. So that was, you know, one reason. The second one was, of course, this was happening as Ethereum was becoming congested and gas fees were becoming prohibitive. You know, using DeFi on Ethereum was generally only affordable from a gas perspective for people that had a certain amount of assets, that it was an acceptable amount of cost to participate. So as an example, if it cost you $300 to deposit into a lending protocol in gas, if you only had $1,000, which is a lot of people getting into the space, I mean, it would take you years to earn back the cost of gas. I'm using outsized examples here. That's actually not the real case. Hopefully it makes sense. And so that was the first reason. We were looking for a more efficient and cost-effective network. One of the exciting things about DeFi, at least from my perspective as a builder, is it offers the opportunity for meaningful yield at its base level for people that otherwise probably couldn't access that, whether they're unbanked or whether the banking systems in most Western countries just don't pay enough meaningful yield because they've got so many layers of overhead and so many complexities that they have to pay for. DeFi offers an opportunity for that, and it should offer that opportunity for the masses. And so on Avalanche or a low-cost network, you know, that was one of the key drivers for us, was let's make sure we can provide meaningful access to people regardless of their portfolio size. So that was one of the first drivers. The only other network that meaningfully existed at that time was BSC. It was called BSC at the time, BNB chain. And you know, we picked a network that we thought was meaningfully scalable, meaningfully performant, and incredibly secure, and it's been that way so far. Avalanche doesn't get the love that it deserves.
I think so too. Yeah, I also think that Avalanche is a bit underrated, to be honest. I think it's a great chain, and yeah, I think that you knew the team before from there, that also probably gave you some confidence.
Yeah, and we had a close working relationship with them, and still do, which is important for us. You know, if we decide we're going to build on a network, we want to know that it's an emerging tech. You have to have relationships with the participants and the you know, the ecosystem, so that we can work together if and when things come up. And I think Avalanche has a lot of other kind of behind the scenes benefits that a lot of people may not know if you're not building. Their tooling is incredibly good. The bridging infrastructure is incredible. You know, the support and ecosystem development is amazing. The core wallet is unbelievable, especially now. And we've only begun to scratch the surface of what Avalanche is actually capable of. Everybody assumes Avalanche is an EVM. That's only one subnet. The C chain that operates as an EVM right now is just a subnet on Avalanche. And the real secret sauce is in how Avalanche becomes more performant, more secure, and more scalable as more and more subnets come online. And we won't get too deep into that here today, but there's some really unique things that you can do on Avalanche that are mind-blowingly amazing. And I think in the coming couple of years, you're going to see a lot of incredible development coming out of Avalanche.
Yeah, so I just wanted to add here that I think in the last 2-3 years, many chains appeared, you know, and maybe it was a supply shock, let's say, with the chains, with the blockchains. Mm-hmm. And I can see that the many things which these chains can do and where they can be used, it's still not visible maybe, or there are not as many companies, institutions, people who can use it, you know. And I do think that in the next 5 to 10 years, that is when every chain will have its category, personality, or features which will be used in different sectors, and that's when they will shine. Let's say that's when we will see the thunder from each of them.
Yeah, I'm still bias admitted here. I have a bias because Benqi's built on Avalanche, but we also have the Roam product suite is chain agnostic. So we have experience with all the major blockchains. And in my opinion, there's still not an ecosystem that has the same current functionality as Avalanche, not even close. And what will become of Avalanche in the very near future, there's no other ecosystem that offers anything close to it. In terms of flexibility and ease of use, and being able to spin up subnets for your use cases, and the composability amongst subnets and so on, is really second to none. And it's very exciting to see what that opens up for the future.
I'm excited as well. Let's go back again a bit to Benqi. I think
Sure.
we are derailing with the topics, but maybe we will do a 5-hour podcast sometimes and we will just talk about everything.
Yeah, I'm definitely down.
Yeah, we will do a Joe Rogan type. We will just discuss until we have a topic. It's 3, 4, 5 hours, doesn't matter.
Yeah, however long it goes.
Let's go back to the assets, because I know that you don't offer any assets and you choose very wisely what assets can people borrow and also what assets can people lend on your platform. Could you walk us through how do you choose the assets which you are offering and also what you are accepting?
Yeah, so there's quite a few things that go into it. From the beginning, and kind of aligned with a lot of the philosophy I've talked about protecting users and our responsibility. There's no perfect solution, of course, but I think definitely best efforts. It should be the minimum acceptable standard. So we partnered with Gauntlet and Chaos Labs. Both are risk assessment and modeling firms. We partnered with them from day one. So we don't make any decisions without Gauntlet's support. But for listing assets specifically, we use Gauntlet. And there's quite a few factors that come in there. But from our perspective, we have to understand thoroughly, or as best as we can, the technical security of the asset on Avalanche. So if it's bridged, how is it bridged? Are we confident with the bridging standard, with the wrapping standard? If it's wrapped onto Avalanche, how is that being done? Is there some weird mechanics where it's being minted and burned and some weird stuff? Because that can cause fairly significant risks that most people don't think about. So that's the first piece. The second piece is, of course, is there utility? Like, is there enough of this asset that exists outside of Avalanche that if we offer support on Avalanche, that people will actually use it? Is it worth our time, and do users actually care about it? And then there's a lot of liquidity and economic risk factors. And so you talked about a couple of them. Volatility is, of course, relevant, but probably more important is liquidity. So in the event of an adverse effect on Avalanche, do we have enough liquidity to not see a crazy cascade? If the liquidity is too low, then the price can move drastically and very, very quickly. But if we do see cascading liquidations, can the liquidation process actually remain efficient? Is there a point where we put assets up for liquidation that someone can then take those assets, liquidate them, and remain profitable? If that all breaks, then of course we end up with a whole bunch of bad debt. And that's the biggest risk for a lending protocol, is bad debt, because depositors, whoever put their money in the protocol in the first place, is who ends up holding the bag, so to speak. They're underwater, they can't withdraw their assets because it's bad debt. And so that's a huge concern for us. Gauntlet looks at that. We don't make any decisions that we don't have complete support from Gauntlet and their economic risk modeling, which is really important. So yeah, there's a lot of factors that go in, but it requires a great deal of assessment and understanding of as many vectors of risk as we possibly can. And I think it goes without saying, we don't list anything also without a Chainlink feed. We need confidence in our price feeds so that the protocol isn't relying on something that can be easily manipulated.
Yeah, thanks. Yeah, that's very cool. And it gives some confidence, because I think people, after the recent events, which you also mentioned. People somehow are afraid of the lending protocols, and we discussed some of the risks regarding liquidation and get wrecked stuff. But lending protocols can also be very useful, and if you are using them right with managing your risks, then lending protocol can be a very good tool for anybody to grow in project, investment, or anything.
It's important to note, I think, that there's two types of risk, right? There's the risk that the user takes in understanding how the lending protocols work and managing their own personal risk and their portfolio composition, and that's important. And I think we should give people as many tools as we can to manage that risk properly. But the other risk that I think we're also very focused on is protocol risk. What are the chances that the protocol stops functioning properly? And that's I think very obviously very important. In good times, when markets are exciting, when everybody's making money and it doesn't matter what you buy, number go up, it's really easy for platforms and protocols to get sucked into the hype, ourselves included. I mean, we looked at a lot of assets that thankfully Gauntlet or somebody around us, one of our advisors or somebody internally said, we should maybe not look at this. That may have met most of the criteria, and pressure from the community to list different assets was incredibly high, but we decided or elected not to because of our commitments to certain parameters. That saved the protocol in the end. There's 3 or 4 assets that I can think of in particular that if we had gone with the hype or excitement, we could have been in fairly hot water. So again, it's
kind of like a FOMO, right?
Kind of, yeah. It's easy to get excited about that stuff. And yeah, would it be great to list every asset from a user perspective? Sure. If you can borrow against every asset that you hold, of course that would be great. But there's a lot more risks than what meets the eye from a protocol.
That's good that you are also having support. And this is what I was talking about earlier, to have some, let's say, independent eye on these things, risk management, to help you decide or maybe to stop you sometimes from providing some service which could harm the whole company in the end, right? Because that's what we saw. Obviously, people were hurt, but also big companies just went down and disappeared.
Absolutely.
Let's say,
yeah.
Or they may never be able to find another client. I think I interrupted a bit earlier because you said that Benqi is not only a staking provider. Benqi is not only a liquidity provider.
Yeah, so we do liquid staking. Yeah, that's another podcast possibly, but we also do liquid staking for the Avalanche ecosystem for the AVAX token. Liquid staking is important both to users but to the network as well. So in proof of stake networks, there's been a lot of talk about this lately, so most people should be familiar. But if you're not familiar, proof of stake networks, essentially, instead of mining and having all of this expensive equipment to mine, what happens instead is you have relatively cost-effective and efficient equipment that validates the network, but you have to put a certain amount of stake at risk, so to speak, so that if you do anything nefarious, you have assets that can be penalized, so to speak. And so every proof of stake network is slightly different. Now, in order for a network to be secure, you need a lot of assets locked up and a lot of distribution of validation. And Avalanche is incredibly good at that. There's a great deal of the assets in circulation are validating or delegated to validators for the network. The challenge with that, and it's a good yield, plus or minus 9 to 10% is the current yield for validation. Now, that's exciting, but you have to lock up your assets for a certain period of time, and you can't use them for anything else. So the same way that lending protocols want to free up equity in assets, we want people to be able to both validate and secure the network, but also have access for DeFi use cases of the equity in those assets. So we built liquid staking for Avalanche, so you can deposit your AVAX. We deal with the delegation in a meaningfully decentralized way. We don't run the nodes. We delegate to nodes that already exist and meet certain criteria, so that we don't have an outsized share or control of the Avalanche ecosystem. But then all of those users, they have a representative token that they can then go and use in DeFi, deposit on Benqi, deposit on Aave, and unlock equity.
That is the S-AVAX, right?
S-AVAX, yeah. And I won't get too deep into how it works and so on, but it is kind of complicated on Avalanche. There's multiple chains that it needs to move between, and how that gets managed was we were working on liquid staking almost immediately after we launched Benqi, and it took quite some time before we launched a public-facing product. And we don't take the responsibility there lightly. If there's an issue in the liquid staking infrastructure, the whole network potentially could be at risk to a certain extent. And so, we worked closely with Avalabs to make sure that the architectural design and security infrastructure was acceptably built. And we've had a very staged launch. We've had deposit caps on AVX into SFX for quite some time. We stepped it up as time went on to make sure everything was functioning perfectly. But it's been a big focus, and it's a huge advantage, I think, for participants in Avalanche to have liquid staking. We've also recently partnered, Rome Blockchain Labs partnered with Alluvial, which is a institutional liquid staking provider. That if you search, I've done a lot of talks, a lot of videos on this, but that's really exciting also, where there's a fully KYC AML compliant version of institutional liquid staking. It won't be SAVAX, it'll be LSAVAX. But anyways, that's going to be launched in December, January.
Maybe we will discuss about that at our next podcast. I do
Sure.
have one more question,
Sure.
The last one. How do you think lending protocols, or maybe Benqi, will look like in 5 to 10 years? Do you think it will change a lot? Do you think there are many external factors to it? Or you think that you are in a good shape? Maybe will be some development, but this, let's say, simple and without any centralized institution between the lenders and borrowers, it works pretty fine. What do you think?
How much time you got? That's a pretty big question. I'll try to give you a quick answer. I think lending protocols and DeFi in general has a lot of work to do still. Not to say that it's not fantastic where we're at right now, but there's a lot of work. I mean, we're still significantly over collateralized. We still have, at least on Benqi, pooled risk, where the lending protocol is still only as strong as its weakest asset. Aave v3 does some different things with isolated pools, and I think there's stuff happening in the space that we're looking at making better use and better protections around the technology for lending. But I think we've got a lot of things as a space that we can continue to evolve on. 5 years is an eternity. I have no idea how to predict what will happen in 5 years, but I'm pretty sure it'll look vastly different than it does now. Ideally, we would get to a point where there's some version of under collateralized lending that works. How does that work? I mean, there's a lot of theories and theses on how to do that, but none of which have meaningfully been put into production with any amount of time to validate any of those concepts. So there's a lot of things that we can do. How do we involve or create some version of on-chain credit? What does that look like? There's a lot of things that I think could evolve, will evolve. Not entirely sure how, but we have to keep focused on those solutions. One very obvious and very notable thing that I think has to change and will change, of course, is the way that yield is provided. Right now, almost every lending protocol, to one extent or another, is supporting yield from liquidity mining initiatives, whether that's like Avalanche Rush in our case, AVX provided by Avalabs that we help bolster yield, or the emissions of the native token. And I jokingly, tongue-in-cheek, call it the liquidity mining circus, because every network is trying to compete with other networks, and every lending protocol is trying to compete with other lending protocols to have better yield based on emissions. It's not sustainable. It drives the price of those tokens down over time because people are farming, which is great as a user. I mean, I've been a huge proponent and benefactor of farming. If you've been participating in DeFi long enough, we all participate in farming, but it's not sustainable from a protocol perspective. It's not attractive as yield because it's highly volatile yield. So that's something that I think we can all agree will have to change. There has to be development of pure yield structures, reimagination of how yield is assessed in lending protocols so that it's attractive enough to offset the associated risk with using a protocol, smart contract risk, protocol risk, corporate risk, market risk. It has to be high enough that it's the risk-adjusted return is acceptable, but it has to be economically feasible without some sort of supplemental emissions. And so I think that's a big piece that has to happen over the next little while.
And it won't happen overnight?
No. Well, I mean, maybe someone comes out with a genius idea that just happens to work, but everything, there's a lot of testing, there's a lot of ideas floating around, but we need to see things get into the market, whether it's stuff that we develop or that others develop, and see how it functions before we'll see meaningful adoption. But that's like any emerging technology, any emerging market. There's time and
yeah, there's a test phase.
Yeah, time and brain power needs to go into solving these problems. And the one thing that gives me confidence is it's a very collaborative space, even amongst competitors. We talk a lot to our counterparts in both in Avalanche and outside of Avalanche, and we're all working together to solve these problems. We're not fighting for this. I mean, short term, I suppose, a very limited view is we're fighting for the same assets, but in reality, there's going to be a future where there's way more assets in DeFi than we can even conceive at the moment, and the protocols that are here and working together to move the space forward will be all benefactors of that.
Yeah, I think this is almost the same as with smartphones, for example. I mean, Apple is pretty good. Samsung still has something to eat, I mean, they're also making money, and there are also a lot of other brands who are producing and emerging and competing, but still growing, and they grew together, with the wave. So yeah, I think that's pretty good. And yeah, maybe there is competition, short term on low key, but it is most important to onboard as many people as possible, because that's how everything will grow at one point.
Absolutely.
And then chains can compete in, I don't know, decades. Anything new announcements, anything the community should look out for in the upcoming near future?
Well, there's a lot of stuff, of course, but I think most notably we're going to be launching VEG in the very near future. At least the first portion of that structure will be coming out. So for anybody watching this, if you're watching it soon enough after the recording was done, come check it out. We'll have a lot more information when that does come out, the first iteration, I guess, of VEG. Again, alluvial liquid staking is pretty important. So we'll have a lot more information about that coming out soon. And all the other stuff we'll just have to keep secret for now. But
at due time, you will be able to find it on Twitter and the website and all the communication channels. And you can also find all the links in the description of this podcast. So, JD, thank you very much for being here. Thank you for sharing all the info and all of your views. I really enjoyed this chat, and I hope that we can do it again sometimes.
It's my pleasure. Be happy to come back and talk about those things once they're released. Yeah, if anybody has questions, of course, just follow up with us. We're always available. Ideas, input, questions, concerns, challenges. Don't be shy. Reach out. It's been a pleasure. Thank you very much.
Thank you.